Welcome to the 3 in 10 podcast. I'm Scott Slayton, partner and chief strategist at Capital Creek Partners. In each episode, I'll give my brief perspective on 3 things we think market participants need to know this week, and we get it all done in 10 minutes or less. For additional resources and analysis, please visit our website at capitalcreek.com. Welcome to the 3 in 10 podcast for Saturday, April 18th, 2026. We're recording at 9:45 a.m. Eastern Daylight Time. I am your host, Scott Slayton, and we're recording on Saturday instead of Friday because I had to travel all day yesterday, consolidate my notes from an amazing week at IMF World Bank meetings in Washington, D.C., where I had the opportunity to listen and interact with over 50 speakers. I took very copious notes from my meetings, one-on-one meetings, presentations, lunches, dinners, and just talking to contacts in the hallways where the real business gets done. And we know from going to this conference for over 20 years that it is wise to bet against the IMF weak consensus. It is usually wrong. The incredible thing is that JP Morgan traders go to this conference just so they can bet against the consensus that comes from the conference. Nevertheless, there were a lot of wise people here, academics, historians, policymakers, and many, many market participants and investors and portfolio managers. So here is the consensus. Here is the Washington consensus that I extracted from all of these meetings. Number one, there's a belief that stagflation is an increasing risk, that higher inflation is coming along with slower growth. The second consensus, the war in Iran is likely to grind on. There was a huge dichotomy between the investors who believed that the war was basically over and the policymakers, historians, academics who felt that it would grind on for a long, long time to come. So those two sides could not agree at all. Next, there was a consensus, an overwhelming consensus that private credit is not a systemic risk. Therefore, I'm more worried than ever about it. The consensus believes that the Fed is on hold for all of 2026 and beyond. 70%, greater than 70% of the people surveyed, and this is a massive survey of about 500 people, believe that the Fed is on hold. The next consensus thing is that the transatlantic alliance that has existed since World War II is broken. And fundamentally broken, that there's just no trust on either side anymore, that there's too much political volatility, not just in the United States, but also in Europe, and that NATO is headed for a breakup. Strong consensus there. Another consensus is that China is ascendant while the U.S. is descendant, that China is gaining from the loss of U.S. soft power, that they're sitting there hoovering up the U.S. soft power and that they're now seen as the agent of stability while the U.S. is seen as the agent of instability. Another strong consensus was that the AI boom will continue for the next several years and drive not only U.S. growth, but global growth and huge productivity gains. So a lot of belief, universal belief in AI as a solution to the many problems. The historians, policymakers, and academics were incredibly bearish on U.S. risk assets, treasuries, the dollar, equities, and standing in complete contrast, the market participants were overwhelmingly bullish on risk assets. The one that scared me the most and was probably the most universal was that the dollar is a short. I didn't hear a single person disagree with this, and many people put forth all the reasons that the dollar is a short. This is a long-held thesis of my own, one that I still believe in, but I must question it after hearing universal belief in this idea. And finally, the last consensus idea is that we're in a new world order. with America isolated and unpredictable and just really having no idea where we're headed from here. We're just in a very different environment than most of us have been in during our careers. So the favorite trades, these trades were distilled down not just by me, but also by the JP Morgan strategist. Number one, long EM assets, both debt and equity. Number two, long commodities, especially gold. There were several strong bullish opinions on gold, but just that commodities benefit from all the chaos, from supply chain disruptions, from shortages, from Hormuz. All of these things point to commodities. That's another one that worries me because I've been very bullish on commodities. Another one is short treasuries. Lots of opinions on short treasuries, including from the JP Morgan strategist. Once again, short the dollar and then short the U.S. front end ahead of potential rate hikes late this year or next year. What surprised me about the conference? First of all, nobody mentioned Bitcoin, not a single time, with over 50 speakers, and it just was completely absent from the conference. That was kind of bullish to me. The survey revealed that 65% of the investors there had no equity exposure or fixed income exposure to China. Interesting. The JP Morgan strategist, Younger Aziz, who is a grizzled veteran and very savvy, that was his favorite idea, was to be long China assets, in part because nobody has exposure. JP Morgan was uniform in the view, and this comes from Jamie Dimon through the strategist, currency strategist, that the next Fed move is a hike. And that surprised me. I really was surprised by that. But uniform opinion from America's greatest bank that the next move from the Fed is a hike. And another surprise there was just a really strong belief that the U.S. is really beginning to run out of borrowing capacity. I think that's crazy. I think we've got plenty more capacity out there, but the belief is that we're running out. Now, I asked AI to distill down my copious notes, and I had, many, many notes from this, and it boiled it down to three things. I put my notes in, and I said, consolidate this and tell me what the three takeaways are. Number one, AI came back with, Iran is not over. Markets may be underpricing the oil and inflation tail. Number two, AI is still winning. It remains the main reason risk appetite stays alive and markets are making new highs. And number three, the regime is changing. Weaker dollar, shakier treasuries, stronger case for EM gold, and real assets. Those were the themes that AI came up with based on my notes. So I take note of that. So I'll end with just the usual: do the work, endure the fog of war, and have investment prudence.
The information in this podcast is educational and general in nature and does not take into consideration your personal circumstances. Therefore, it is not intended to be a substitute for specific, individualized financial, legal, or tax advice. To determine which strategy or investment may be suitable for you, consult the appropriate qualified professional before making any final decision.